Hello friends. In the last two videos, we discussed about the basics of mutual funds and different types of funds like large cap funds, mid cap funds and small cap funds. In case you missed watching those videos, you can watch them here. So you have decided to invest in mutual funds and you have chosen maybe small cap funds, just to give you an example. And you see that Nifty is rising, but your fund value is decreasing. Or you have chosen mid cap funds, Nifty is still rising, but your fund value is decreasing. Now, why does this happen? Because if Nifty is rising, ideally your mutual fund value should also increase, right? But that is where the catch comes in. Because if you have the small cap fund or the mid cap fund that they've chosen, it wouldn't cover the entire spectrum of companies covered in mid cap or small cap. So, the fund manager of your particular mutual fund, he must have done some research and he must have come to a conclusion that a certain set of companies, maybe out of the 100 large cap companies, he might have chosen maybe 20 or 30. Due to some timing or some unforeseen circumstances, these 20 to 30 companies might not perform well, and the other 70 companies might perform well. As each company is governed by a lot of different factors, this is a common case. When the companies that constitute your specific mutual fund, they don't perform well, your mutual fund value starts decreasing, even when the entire index, such as index like Nifty or Sensex, is increasing. So this is where the catch comes in, as there is a human bias in picking the stocks. So you still want to invest into equity mutual funds, but do not want to. You want to mitigate this risk. What to do? Now that is where index mutual funds come into the picture. Welcome to RT's Tax Info. So what are index mutual funds? Index mutual funds are those funds where your fund manager chooses a particular index like Nifty 50 or Bank Nifty or Sensex or Nifty Total Market Index, just to give a few examples. He chooses a particular index and invests your money into that index, covering all companies. So in Nifty 50, as you guys know, it comprises of 50 companies. So your fund will get invested into all these 50 companies in the same proportion as that of the Nifty 50. If it's Nifty Total Market Index, that covers around 750 companies. So your money gets invested into all these 750 companies in the same proportion as that of the total index. So what happens is, if the index is rising, your fund value also rises. So these are index funds. Now, as there is no human bias in picking this stock, and your entire money gets invested in the same proportion, these are called passively managed funds. So the aim here is not to outperform the underlying index. It is to match the returns or mirror the returns or mirror the performance. So the returns that you get will almost be same as that of the index. So if the Nifty rose by 11%, you'll also get around 11%, not exactly 11%. There'll be some minor differences, very minor differences. So an index fund can consist of equity and equity related instruments and bonds as well. So this way the diversification that you get is much more, and you get a piece of the broader market segment at a lesser cost. As this is passively managed, the fund costs are also very less. So if chosen well and the index that if chosen is performing well, your fund returns will also be good. But if it's a market slump and the markets are falling, it is always better to switch to an actively managed fund like a mid cap fund or a small cap fund or large cap fund or any other fund of your choice. But an ideal equity portfolio would consist of a healthy mix of an actively managed fund or several actively managed funds and several index funds as well. And apart from this, if you see, the expense ratio of an index mutual fund is much lesser than that of an actively mutual fund. In an actively mutual fund, like a mid cap fund or a small cap fund, the fund manager has to constantly keep track of the companies that he has chosen, and based on the performance, he has to either sell or buy and keep doing a lot of transactions at regular intervals, which is not the case in an index mutual fund. So, as the involvement of the fund manager is much lesser than that of an actively managed mutual fund, the expense ratio is also less. But the only thing that the only or the main thing that you have to keep track of is something called tracking error. Now, tracking error is a technical term. It is the difference between your fund, the return that your fund is giving, and the return the index has generated as a whole. So suppose Nifty has increased by 11% and your fund has given a return of 10.5%. The tracking error will be 0.5%. So when you're choosing and when you're going for an index mutual fund investment, the fund with the lowest tracking error is the one you should be going for. Now, what are the different types of index mutual funds available in the market? There are a lot of different categories like broad-based funds, funds based on market capitalization, funds based on sectors and themes, etc. Like you have Nifty 50 funds, or Nifty mid cap funds, Nifty small cap funds, or a combination of large and mid cap funds, or a combination of large, small, and mid cap funds, or IT specific funds, or bank related funds like bank Nifty funds, or government securities based funds. A lot of different options are there. So the kind of fund that you have to choose entirely depends on your risk appetite and your goals. If you feel that a certain sector or a certain category of companies like small cap companies or large cap companies, or a certain theme like agriculture, whichever sector you feel has a growth potential, you should go for that fund. The main thing that you have to keep track of is the tracking error. So always go with the fund which gives you the least tracking error. An interesting and a recent addition to the index mutual fund is the international index fund. Now, if you are living in India and you want to invest in a US company, the documentation and the formalities are not that easy. But these international index funds give you an opportunity to invest in S&P 500, Nasdaq 100, etc., etc., etc. This is very popular among the Indian investors who have come into the picture in the recent years. So, who should invest in an index mutual fund? If you're someone looking for predictable returns in the foreseeable future, this is the fund that you have to go for. If you are a beginner, if you're choosing something like Nifty 50 or Bank Nifty, there is not much research that is required, and you can right away start investing. If you are a passive investor, as in you will invest and forget about it, and you will come back only after several years for enjoying your returns. If you are someone like that, then you're called a passive investor. So if you're a passive investor, this is the best kind of funds that the best kind of mutual fund that you can invest in. And finally, if you are risk averse, that is, if you are looking for diversification, you do not believe in a certain sector or a certain theme or certain kind of funds. You are only interested in owning the entire market, the broader market segment. You believe in the index as such, index as a whole, and you believe that in the next 10 or 15 years, it will give you, say, 10 or 15% returns. If you're such an investor, if that is the kind of risk appetite and goals that you have, then you can go for an index mutual fund. These funds have a tendency to underperform in the short term, but in the long term, all these fluctuations will be evened out or averaged out. And if you are invested at least for a period of 7 to 10 years, the returns that you can enjoy would be in the range of 10 to 20%, which is very good compared to other traditional instruments like FD and RD. So most experts have the opinion that if you're looking for a long-term return from an index mutual fund, the best way to go about it is not through a lump sum, but through an SIP model where you invest a certain amount of money every month. This SIP investment will average out all the fluctuations in the market in the long term. So that's all about index mutual funds. If you want some aspect of this video to be explained in detail, please share a comment and I'll be happy to come out with another video explaining it in much detail. Please share, like, and subscribe our channel for more videos like this. I'll see you in the next video. Thank you.